Okay, so I'm going to talk about two areas, which is income and leases. And as Giles mentioned, the SORP is based on FRS 102, which is an accounting standard that applies to lots of organisations, not just charities, and SORP interprets it for charities. So FRS 102 has been updated. So one of the things that the new SORP does is introduce some of the changes to FRS 102 for charities. And this is an area that that's relevant to. So FRS 102, the income treatment and the leases scheme has changed, and therefore the SORP needs to change as well to introduce the changes. So whilst we're talking about this from the perspective of a charity, these changes will apply to your trading subsidiary, and they will also apply to any commercial organisations that you're involved with as well. And it's income and leases where we could see some changes in the way that you account for things. I'm going to talk most about leases because I think that's most likely to see an accounting change. The income change is more a change in the model that you use to determine when you recognise your income, but you'll probably end up recognising it in exactly the same place, and therefore there won't be an actual change. What the new income approach is, it divides your income into two different types. It refers to exchange transaction income, and that's the one that's changing, and non-exchange transaction income. So an exchange transaction is where you sell goods and services under a contract to a customer, and the customer then pays you for receiving those goods and services. And that contract could be written, it could be verbal, it could be part of your terms and conditions. So most charities will have some of that type of income. All of your other income is not exchange transaction income, and that's things like donations, legacies, grants, and that's not changing. And it's called non-exchange transactions because you are receiving value, a donation to whoever's giving it to you. You're not getting anything back to them. So that's not changing. So for some charities, it could be that all of your income is non-exchange transaction income, so nothing changes. But probably most charities will have some form of exchange transaction income of changing. And what the change is a change in the model in terms of when you work out when to recognise your income. So what the new requirement is, it's a requirement to look at the contract, as I said, it might not necessarily be a written contract, and look at what the promises are in that contract. So what have you promised to give to your customer in terms of the goods and services that you're providing that they're then paying you for? And then you recognise your income as those services are delivered. So in most charities, that won't change anything. So the types of income that's going to be affected, for example, if you've got a charity shop or you've got a cafe, that's an exchange transaction. There'll be things like if you're a theatre and you sell tickets, or you put on educational courses and people pay you to attend. So if you look at that first example where you've got a cafe or a shop, your promise is that you're going to provide some food to your customer, and you will recognise it at the point that you do that, which is exactly what you do now. If you put on a theatrical production and sell tickets, your promise is that you will put on a show and that people will then be allowed to watch that show. So again, you recognise your income at the point you put on the show, which is exactly what you do now. So on the income side, for all charities, there will be an exercise to do to look at your income, split it between exchange and non-exchange, and then the exchange, look at your contracts with customers, look at your promises, and see whether that changes your income recognition, but you'll probably end up with the same answer. Two scenarios where it might change to perhaps it wasn't right in the first place. It might be if you revisit what you're doing and you look at the promises and you come up with a slightly different answer. That could be because perhaps the answer what you were doing previously wasn't quite right. And the other situation where it might happen is if you're bundling your income. So if you receive one lump of income, but actually you're providing multiple promises to your customers, the requirement now is to split that income into your individual promises and then recognise it separately. And again, you might end up with a different answer from doing that. So like a membership income might be the type of example where that could happen. So that's the income side. So there's definitely going to be a piece of work to do. The chances are you'll probably end up doing what you've already been doing. The lease accounting is different. Again, it won't affect everybody, so you won't all have a lease that's going to be relevant to or require a change. But if you do, it will definitely change the accounting treatment. What the new tune is, it refers to bringing all leases on balance sheet. And probably the best or a good example of what the type of lease can be affected is like this building. So this building is owned by Alan Boswell, and we lease the majority of this floor off them. So at the moment, we will have nothing on our balance sheet, no asset, no liability for that, and we'll just recognise rent through our equivalent of our sofa each year. And I'd imagine you'll be the same if you rent any of your premises. What the new requirement is to bring that on balance sheet. So going forward, we will end up with an asset sitting on our balance sheet called a right of use asset that sits in tangible fixed assets, and that represents our right to use this asset going forward. And then you'll end up with a liability on your balance sheet, which represents the future lease payments you're going to have to make. What's not changing is accounting for lessors. So the lessor is the body or the organisation that actually owns the asset and leases it to somebody else. So in that scenario, Alan Boswell leasing it to us, their accounting treatment won't change, they'll do the same. So it might be your charity sublets part of your building, or you've got separate buildings that you're leasing. If you're doing that, it won't change. It'll only change if you are the organisation that's leasing it to someone else. And in terms of what you do, I'll give you an example after this that'll show it better. In terms of the what you do is you start with the payments you're going to make. So you look at the obligations you've got under the lease, and then you discount them back and calculate from the future to the present value. Because, for example, like paying £100 in 5 years' time is not the same as paying £100 now. You discount those future payments back to today's value, and you're going to do that probably using either of those two options on there. If you can do the first one, you need to do that. You would only go to deposit rate if you can't do the first. So the first one is the rate at which you could borrow money. So if you know how much the interest rate you would pay to borrow the amount of money that would be the lease for the length of the lease and the amount of the lease payments, you use that rate to discount the figure. If you don't know that rate, you can use the deposit rate. So that's the rate that if you were to deposit that amount of interest at the bank, what rate would you get from the bank to do that? And that deposit rate option is only available for charities, and that's available, well, not for profit, and for charities. And that's in there because most charities don't borrow, so you might not necessarily know what your borrowing rate is, so you can deposit rate. If you do that, you calculate what that figure is, that becomes your liability in your balance sheet. Then exactly the same number becomes your right of use asset, sit up in fixed assets. And here, this is an example. And this example is also dealing with transition as well, so how you do it in the first year. So in this example, we've got a charity with a 31st of December year end. So as Joel said, in terms of when it's going to be applicable, so 31st of December year end means you're going to be applying in the year end 31st of December 26 first. So your transition date will be the 1st of Jan 26, so that's 6 months away. So they've got a lease. The lease is 10 years old with 3 years into that lease. We've got 7 years left, and we are paying an annual rent of £120,000. And we know our borrowing rate, so we can borrow at 7%. So on the first day, on the 1st of January 2026, we have to calculate the present value of those future payments. So on transition, you ignore the past. So what happened in the 3 years so far, we don't have to worry about that. We don't restate comparatives. We don't restate our open balances. We're only interested in the future. So if you discounted the 7 years worth of £120,000, that's at today's value, at 7%, you'd end up with a figure of £646,000. So on day one, 1st of January 26, we will record in our accounts an asset of 646,000 and then a liability of the same amount. So on adoption, it doesn't change our net assets at all. We're not changing our funds, we're just increasing our assets or increasing our liabilities. In terms of how we then account for that going forward, if we look at those new accounting columns to start with. So I mentioned that we're going to be bringing on our balance sheet an asset of £646,000. And we treat that in the same way as we treat any other fixed asset. We're going to depreciate it. We've got 7 years left of our lease, so we're going to depreciate it over 7 years. So going through your sofa under the new rules, you will have a depreciation charge of £92,000 each year, which, as you can see, comes to the total of £646,000. So on your balance sheet, your fixed asset will be reducing each year by 92,000. It'll come down to nil at the end of the lease. We then also calculate an interest charge. So you're going to end up with a finance charge going through your SOFR. And that's calculated by multiplying the liability of sitting in your balance sheet by that 7%. So if you took 646,000 times it by 7%, you'd have that £45,000 interest charge. And we'll have an interest charge going through every year. It's reducing because the liability is reducing each year. So on your balance sheet, to start with, you'll have a liability of 646,000. You'll reduce that each year by the £120,000 rent that you're paying, but then you'll increase it by the interest charge. And that too will come back down to nil at the end of the lease. Your liability will be nil by the end of the lease. So under the new accounting, we'll have two different types of costs going into our SOFR, which, as you can see from the totals to the bottom, will be £840,000 at the end. On the left-hand side is what we would do at the moment. So at the moment, we'd have no asset and no liability. Our balance sheet, there's nothing there at all. And we have £120,000 a year rent going through, really straightforward. On this right-hand column, we've then got a comparison between the two. And the most relevant thing is going to be that bottom right where we've got nil. So under both of these approaches, the total cost that goes through your SOFR over the length of these will be exactly the same, it's £840,000. But this new accounting is doing three things. So one of them is it's converting what was previously rent into depreciation and interest, and you have different types of costs going through. And then as you can see in the right-hand column, there are differences in the individual years. So whilst in total it's exactly the same, the new approach will mean that there's more cost going through in the earlier years of the lease and less cost going through at the end, albeit it all comes down to nil overall. And that's because your lease obligation is reducing. That's why it goes that way. And the other thing we'll do, after changing your balance sheet, you're bringing an asset on and you're bringing the liability, albeit they come down to nil at the end of the lease. So you'll be applying that to the vast majority of your leases, but there are a couple of exemptions that allow you to continue with the current treatment. And I'd imagine that if you do qualify for any of these, you will use them. The first is the low value assets. So if you could consider that the actual asset that you're leasing is low value, you don't have to do this, continue with what you were doing before. There is no financial threshold for low values. It's not assets that are worth less than a certain figure. There are also no examples of what a low asset value might be, unhelpfully. But it does tell you what it's not. So it's not cars, it's not vehicles, it's not land and buildings, it's not big bits of equipment. So there will be an element of judgment there. And I can only really think it's going to be perhaps small pieces of office equipment or something like that might qualify, but whether people actually lease them, I probably doubt. So not many are going to qualify under that. And the other one is this short-term one. So if your lease is less than 12 months, you don't have to worry about it, you can ignore it for that. So just a few other considerations related to this. The first one, as I mentioned, we're changing some of the numbers in our accounts. So we're changing rent, it's now becoming depreciation and interest. We're bringing on an asset, or we're bringing on a liability into our accounts. And whilst it's probably going to be not quite so relevant to a charity, loan covenants can quite often use some of those metrics in the covenants. So some of your numbers that might feed into loan covenants will change. I appreciate not that many charities have loans, but if you do, that could be relevant. It could be relevant to trading stuff. And the other issue is gross assets. So the treatment is definitely going to increase your total assets in your accounts because you're bringing on this right of use asset with some or one audit threshold and certainly company size criteria are based on total assets. So there is the potential of a new treatment, especially if you've got a long lease for property, could push you over one of those thresholds. Intergroup leases, there's no exemption. So if you've got a lease between your charity and your trading subsidiary, you will be adopting this for your trading subsidiary, but then obviously backing it all out in your group accounts. Peppercorn and nominal payment leases. So sometimes a charity can occupy a property under a lease, but the actual payments are peppercorn or nominal value. That doesn't meet the definition of a lease for the purposes of this, because there needs to be a payment of substance. So if you've got one of those, you can ignore this accounting for it. It's not relevant. And the final thing is receipts and payments accounts. It's not directly relevant to the new SORP, but receipts and payments accounts are a type of account that if you are a non-company charity, so a trust or a CIO can adopt if your income is below a certain threshold, which is currently £250,000, although it's proposed that will increase. And it's much simpler. So they don't follow the SORP. So all this stuff that I'm talking about just wouldn't be relevant. Your accounts are much simpler. So I just raised that because if you are a charity which might qualify for that, but you're not currently doing receipts and payments accounts, now might be as good a time as any to reconsider that. So it could have been a decision to go down the SORP route was made a number of years ago. It could have been made by people that are no longer involved with the charity. So again, probably a good opportunity to consider that. I don't think the new SORP itself would change the decision, but it might be worth reading into that. That was everything. Okay, sorry. Yeah, so just in summary, as Joel said, it's going to apply from the 1st of January 26 at its earliest. You're not going to be finalising those accounts until 2027, so it's still a long way away. There's plenty of time to get to grips with this. If you do have a December year end and you obviously you are going to be affected by these things and you want to incorporate it into your management accounts when you start or budgets, obviously you've got 6 months or so to deal with that. But I think it's just about thinking about what your lease arrangements are, thinking about what your income streams are. Do you think there's some work to do in this area? If you've got any questions, obviously speak to us. In terms of the lease accounting, working out the numbers, there'll be spreadsheets available to do that for you. That'll be quite straightforward. It's just about understanding the leases, and there will be some judgments in there that you'll need to make. That's a bit simple and probably not pressing numbers.
The piece that the other way in the case that they could have a mix that is actually quite high value. It's idea that there might be multiple people that you do the level I pay or something like that.
Yeah.
But because it's very value asset,
Yeah.
the treatment though if when I nature.
Yeah. And in terms of materiality, the materiality is not relevant inside the organisation. So almost the organisation is irrelevant. It's the actual asset itself. Yeah. Anyone else got any questions in these two areas we've spoken about? The little past to Giles who'll confront trustees report.
As just one question, because often the leases you could have a break clause.
Yeah.
So would you continue for the whole of the lease or just up and break?
Yeah, well, you've got to make a judgment about whether or not you think it's likely or not that you will exercise that break clause. So if there's a break clause after 5, if it's a 10-year lease, break clause after 5, but you're pretty sure that you will exercise or you will carry on for 10 years, you treat it as if it's a 10-year lease. If you're pretty sure you will break at 5 years, previously at 5 years.
That could be not sure.
If you're not sure, then I wouldn't feel it's just either 5 years. But then I have simplified some of these things, but then going forward, if you were to change your mind and actually if features 8, you think it is like that you would continue for the full 10 years, you'd then have to change your premium and go to the full 10 years.
And you still remind me that anything after 8 is liability that you've got anybody separate.
Yeah, so you still have a dilapidations provision. That would sit as a separate liability in cash. Yeah.